Self-directed IRA asset creditor protection. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial, and welcome to another episode of AdBits. Today's episode, we are going to be discussing self-directed IRA asset and creditor protection, which is one of the strong advantages of using an IRA to invest. So the main purpose of the IRA world is to allow people to save for their retirement. And in doing so, the government, when IRAs were created back in 1974, needed to encourage folks to save. So the way they created the IRA regime is they said, okay, we're going to give folks two advantages in order to incentivize them to save. The first is a deduction for traditional IRAs, the amount you contribute. Now, the Roth came along later in 1997, which is an after-tax IRA with no deduction, but the traditional IRA still remains a very popular option. And with the IRA, pre-tax comes a tax deduction. And number two, tax deferral. The money in the IRA, the investments, the income and gains will flow without tax. Okay, meaning if you sell a property at a gain or a stock or a Bitcoin, that gain goes back to the IRA without tax. That's known as tax deferral. Okay. And that's obviously a very, very, very important part of the IRA regime is not only do you get a deduction, but you are also going to be getting the power of deferral, meaning your funds will be able to grow quicker based off the rule of 72. After assuming an 8% rate of return, 9 years, you will have doubled your money. Okay. And if you get higher than 8%, take a shorter amount of time to double your money. So asset and credit protection is another really important advantage of the IRA. So I'm going to start with the IRA protection in bankruptcy, and then I'm going to move outside of bankruptcy. So what happens if you go bankrupt personally? Could someone touch your IRA? So under the federal bankruptcy rules, so the 2005 Bankruptcy Abuse Prevention and Consumer Protection Act, and it became effective for bankruptcies that will fall after October 17, 2015. The exemption for IRAs is now $1.512 million, meaning if you have less than $1.5 million in your IRA, which most of us do, and you go bankrupt, no creditor of your personal estate could touch your IRA. That's under federal law. So if you personally go bankrupt and you have less than $1.5 million in your IRA, no one can touch it. Okay. Now there are some exceptions for like alimony and child support, or if you owe the IRS money, of course. But in general, if you have a private creditor and you have less than 1.5 million, they can't touch it. That's if you personally go bankrupt. A lot of people get confused and say, what happens if my IRA invests in a deal and it loses money? Well, that's not personal bankruptcy, right? Your IRA is going to lose the investment. There's no losses in an IRA. If you invest 100K in a deal and the company goes bankrupt, you have zero left. Okay. This podcast is about if you personally either go bankrupt, can someone touch your IRA? And if you don't go bankrupt, but you have creditors out there because you don't want to file bankruptcy, what happens? So taking bankruptcy first, it's the easiest. Federal protection, if your state follows federal protection, less than 1.5 million, protected under the Federal Bankruptcy Act. Over 1.5 million, it could be subject to attack. Okay. And again, this is under the Bankruptcy Abuse Prevention Consumer Protection Act. It came into being in 2005. I said 2015. It should be 2005. Sorry. So what happens if you don't go bankrupt? Well, it's then a state-by-state survey. So if you go bankrupt, you're generally under federal rules if your state follows the Federal Bankruptcy Act. If it doesn't, it would have its own state rules. If you don't go bankrupt, then you are into the state arena to determine what rules apply. And it's generally going to be your state of residency, right? It's not where your IRA is set up. You have an LLC IRA in Delaware. You live in California. It's going to be based off California law, what the rules are for protection of your IRA. Now, every state's different. And I've done a blog on the 50-state survey, which I will get linked in the notes. to this podcast, but basically just kind of surveying a bunch of states. So I'm going to pick the larger states. For example, California, which is the most, I guess, creditor friendly. It's up to a judge to basically say what's reasonable, necessary for you to keep. If you remember the O.J. Simpson trial, that's why he ended up moving to Florida, because it had much better protection. He had a 401k. That was his major asset, basically an annuity in a 401k or insurance in a 401k. And he was worried California wouldn't be able to protect it. So California is very, very strong protection. Strong for the creditors, not for your IRA. Let's say Colorado is 100%, but doesn't have Roth IRA protection. Connecticut 100%, Delaware 100%. So this is outside of bankruptcy. DC 100%, Florida 100%, Georgia 100% of undistributed interest, but distributions exempt to the extent reasonably necessary support, and there's no Roth IRA protection. Hawaii 100% of funds deposited at least 3 years prior. Illinois 100%, Indiana 100%, Kansas 100% for principal. Kentucky 100%. The exemption does not apply to any amounts contributed to an IRA within 120 days of bankruptcy. 100% for Louisiana. No contribution to an IRA exempt if made less than 1 calendar year. So if you just stuck money in and you go bankrupt, whatever's in for that year is not counted. Maryland 100%. Mass limits the deposits equal to 7% of debtors' total income in the preceding 5 years, which isn't that big. So Mass doesn't have a great protection. 7%. So if you have a $100,000 salary, it's only $7,000 bucks. It's not very good. Michigan 100%. Minnesota limited to around 60,000 plus inflation, so very low. Mississippi 100%. Missouri, again, limited to the extent reasonable necessary support, which is like the California threshold, up to a judge. Montana 100%. Nebraska also limited to the extent reasonably necessary to support yourself. Nevada limited to present value of about 500K. New Hampshire 100%. New Jersey 100%. New York 100%. But anything that was contributed within 90 days of bankruptcy, not protected. North Carolina, 100%. North Dakota, 100,000 per account, very low. Ohio, limited to the extent reasonable and necessary. Oklahoma, 100%. Oregon, 100%. PA, 100%, but limitations if you contributed within the last year. Rhode Island, 100%. South Carolina, also limited to the extent reasonably necessary. South Dakota, limited to $1 million. Tennessee, principal 100% exempt. Texas 100%. Utah 100%, except what contributed in the last year. Vermont has a bit more complexion, and you essentially have protection, but there are some caveats to it. Virginia limited the extent to one or more plans sufficient to produce annual benefit of up to 25 grand based on an actuarial table, which isn't strong. Washington 100%. West Virginia, principal is 100% protected. Exemption for distributions limited to the extent reasonably necessary. Wyoming 100%, except for exemption of interest of owner-employee plans. Wyoming 100%. Sorry, that was Wisconsin. Wyoming 100%. That's it. So most states will protect up to 100%. Some caveats for funds contributed in the last year or so. Then you have some states like California that talk about reasonable necessaries to support yourself, which is really an arbitrary determination based off a judge. So again, this is outside of bankruptcy. If you're inside of bankruptcy, maybe you filed for personal bankruptcy and your state follows the Federal Bankruptcy Act, you have up to $1.5 million exemption. If you don't want to file bankruptcy, but got creditors out there, then the creditors can potentially attack your IRA depending on where you reside. Although most states will give you 100% exemption. So that's it. If you are a client of IRA Financial, have questions, let us know, please. We'd be happy to go through the rules with you with respect to your state. Otherwise, it's just another advantage, another reason why you should save in a retirement account, besides the tax benefits, the deductions, the ability to do alternative assets. the tax deferral, tax-free growth, the strong asset and credit protection is really important. I mean, you don't ever want to be in that situation, but if you are, and you'll be happy you have most of your savings or a lot of your savings in an IRA or 401k, which will give you strong asset and credit protection inside or outside of bankruptcy. That's it for today's podcast. Hope you enjoyed it. Really appreciate you guys hanging out with me today. This is a weekly podcast, and don't forget to check it out each week. Please, just a request. If you can give it a good review or a thumbs up, it will get a better rating, and then more people will get to listen to it, and more people can learn from this very important podcast. So just some housekeeping, really appreciate it. And if you have questions, comments, send them in. Would love to hear from everyone. That's it. Great day. Take care. Thanks for hanging out. See everyone again next week. Ciao.